Lori, there's always a lot of talk about how the stock market isn't the economy isn't the stock market. I know economic conditions matter, but if you do see a tail off in consumer spending, how much do you think that could matter for equity investors?
Well, thanks for having me, Romaine. It's great to see you both again. Look, I think, what you said is very true, but I think an interesting factoid, and by the way, I love your one about the Mondays. I think an interesting factoid that I've seen on both the S&P 500 and Russell 2000 is that really, kind of in the post-COVID world, they've been trading very closely, if you look at trends on a year-over-year basis, with consumer sentiment data. So I guess what I would say is if we're looking at the consumer slowing down a bit from a spending perspective, we'd have to look at the underlying reasons for why that's happening. Is it happening because consumers are feeling terrible, that really trends are starting to become more onerous, or is it because they're becoming more value conscious, choosier, more rational? And one of the things we've talked about in this last reporting season is that if you looked across different sectors, across different industries, what I saw at least was not evidence of a consumer falling off a cliff, but a consumer that was reacting appropriately to the price pressures that were around them. I talked to one client today who said the consumer is essentially boycotting some of these higher prices. And I love that term. I think that's a great way to describe it.
Yeah, you can sort of throw me on that pile as well, Lori. A lot of sticker shock still out there, despite all the talk we have about inflation coming down. And to be sure, at least as far as headline numbers go, the official data goes, we've seen inflation come down, I guess in a meaningful way, meaningful enough that we're now talking about the Fed permanently on pause and maybe even something different as we get into 2024.
I think that's right. And, one of the questions we have is, when you start to look into 2024, what are the key themes and what are the key narratives that are going to be driving equities? And I don't think the street has quite figured that out yet. I think this conference season that we're starting to go into, really kind of that September period where it seems like every sector and every bank has a million conferences going on. I think we're going to start to get some hints of what those narratives are. But I do expect as we get closer to 2024, closer to year end, we're going to be talking again about the possibility of Fed cuts next year and how that's going to be boosting or perhaps impeding different parts of the market.
Lori, one area as we wait for some clarity on the economy, on the Fed and everything else that you like in particular is energy. And I'm looking at the 3-month performance. Energy up by 11.4%, outperforming every other sector in the S&P 500. You say it still looks pretty interesting despite this outperformance.
Yeah, and to Romaine's term on sticker shock, I looked at a chart last week of just sector performance since the beginning of August in the S&P, and I looked at it on the Russell 2000. It's just staggering how much energy has outperformed. And there have been some rumblings, I would say, around the street of maybe things have moved too far, too fast. Our commodity strategy team has said, things still look structurally very good, but maybe the oil price will take a little bit of a breather. What I did was just kind of double down and look at my models on valuation and earnings revision. I saw two things very clearly. Number one is whether you're looking at the Russell 2000 or the S&P 500 energy stocks on a median basis relative to the broad market, valuations still look very, very compelling. So despite that big move, we still have a very, and frankly, deeply attractive valuation profile. Number two, earnings revisions are starting to improve in the energy sector. And in the S&P 500, we're actually now seeing mostly positive revisions again. But importantly, we're very early on in that earnings revision recovery. So I will say, two sets of models for both small cap and large cap are still sending me very strong buy signals at this point in time. And if you add on to the fact that the growth trade really still looks tactically overvalued and overbought and in due for a breather, you've got to find, some parts of the value cyclical part of the market for that market cap to rotate into. And I think energy is one of the most attractive areas.
So you're saying that energy can hold on to its gains and even build on them, even if oil prices may have topped for now. I mean, WTI is at $87 a barrel. It's at the highest in a couple of months here, and there are some discussions that perhaps it might have gone too far too fast.
I think in the energy sector, when we look at performance, we're always sensitive to the direction of oil prices. I think, if it's sort of a modest consolidation, treading water, I think the sector can withstand that. If there's some sort of major collapse, which is, not what anyone over here is looking for, then, of course, you're going to have to rethink a thesis. But, I think the idea, that I'm hearing from some in the trading community that, this has just moved too far, too fast. I'm just not seeing that on my models. I know some people feel that it has been a very fast move, but at least from a valuation and earnings revision perspective, we've still got a lot of room to run before I'll start to get worried on that basis.